Hello everyone. I've been meaning to do a series on how various asset classes behave during inflationary crisis, deflationary crisis, uh, stagflationary crisis, um, and this is the first of those videos. I have picked a Great Depression, 1929 Depression, which was a deflationary crisis, and we'll go through some of the charts to see, how different asset classes behaved during that time. So most of you probably are already aware. 1920s we call roaring 20s. Credit was easily available. Money was free flowing, I guess, because of Federal Reserve, and that led to increase in prices and inflation, and ultimately when the time came to pay the piper, it caused a depression which we now know as Great Depression, and stock market crashed significantly. So starting with that, this is the first chart. So as you can see, from 1920 to 1955, and somewhere around here, it went parabolic. Um, so let's say 1926, and then it went parabolic. There was a fake crash in 29, and then it ultimately went all the way down uh, to to its bottom, rock bottom, in 1932. And then from there on, it started increasing again. So it basically lasted anywhere from 26 to 32. So it lasted a few years. Um, this is completely deflationary, as you can see. The prices, the stock market basically collapsed almost. Actually, this is a really good chart here, actually showing you it collapsed all the way from peak to the bottom in 32, 90%. And from second peak uh, after the fake crash, 86%. So there was a fake crash, then went back up, and then crash again, as is visible from here. So it went up, fake crash here, then went up, and then down. So significantly deflationary event for stocks if there is no uh, credit spigots open from the Federal Reserve. So if today Federal Reserve uh, acts the same way, then almost with 100% certainty, we can say similar situation will happen. Equilibrium would be deflationary, or rather I should say extremely deflationary, because the sheer amount of debts now are absolutely off the charts. So that's how the stock market will behave. Moving on, how would the real estate behave? Now, real estate is interesting because not every real estate is same. Um, as you can see here, most of the real estate collapsed to its bottom around 1920. It increased a bit into the mid 20s, and then from 25, 26 onward, it started collapsing against into 1930s, up to 32, where it bottomed just like stocks and then started increasing again. Not significantly higher, but it matched the same prices in 35 around. What were the prices around 25 as well. So it doesn't go in too much detail, but basically collapsed in prices that already happened, and then there was small increase and then some further downside. Let's see what this one shares. Yep. So it 25 to 32, it was some down and then some back up. So yeah, but majority of the crash has already happened before this 925 in prices. Whereas, as I said, not every real estate market is same. Manhattan was roaring in 1930s. So high end and low end both were extremely high. Low end had peaked already, you can say by 2027, but high end peaked around 29 and then they crashed really bad. And the high end crashed all the way near about 70% and the other one 60%. So again, uh, during the crash, if there are no money spigots, uh, prices should go down. More so in today's scenario, again, prices are extremely high, all across the world. Again, there may be markets which are reasonably priced. I'm not going to, you know, paint everything with the same brush, but uh, by and large, valuations are very high. So the prices should go down significantly. Moving on, oil. Oil again behaved like housing. So it peaked in 1920, then it crashed to into mid 20s, went back up a little, and then it crashed all the way to 32, just like other asset classes. So one common theme we can deduce here is all the prices uh, are going down. In deflation, everything is going down basically. Well, so far. So at least stocks, real estate, and oil. More stocks, but others are also going down. And then it started increasing again into mid 30s. I can't find any other good detailed chart on oil around that time. I need to maybe, dig a bit more deeper, but you get the idea. Moving on, wholesale wheat prices. So wheat actually peaked again, just like oil in 1920s, down in mid 20s, went back up just like oil, then all the way down to 1932, and then started increasing again. Just absolutely like oil. This behaved just like oil, and by and large with real estate as well. Next one is wages. How did the wages behave? So this dashed orange line is the wages. So if in 29 if wages were like this, wages decreased a bit into 1932, but then started picking again after that. Whereas during that 30s and 29 crash, industrial production basically almost halved, less than half. So if it was here at near 100, it went below 50 in 32, or right after 32. It means the industry, if industry is down 50%, that means um, uh, you will have to retrench all the staff and the workers. So in other words, personal income should go down, and which is reflected by this dashed greenish line, that it is almost following that same trend as industrial production. So if you're not working, your personal income is going down. However, whoever was employed, their wages didn't go significantly down. They went down a bit, but not a lot. It didn't follow the same curve as the industrial production and personal income, which makes sense. So if you're employed, fine. But if a majority, a lot of public probably got unemployed. So yeah, that's on wages and in general industrial production. Lastly, gold. Gold had gone to its bottom in 20s when others like oil and real estate and others were peaking, and then it went up in a little, went sideways, and during the 29 depression, which is actually here in the gray, it went parabolic. It went up straight. While everything was going down, this was going up. So that actually we can maybe deduce also that during deflation, gold is a good uh, item to have, or asset to have. Now, tying it all back together to today's scenario, I don't think initially we may see deflation. Although the deflationary pressures are humongous, I mean, we're talking about like 500 trillion debts, economy, debts, probably even more, including liabilities. And if we start including, derivatives and stuff, then it's probably what, 1.5, 2 quadrillion. The world GDP, what come last to last year, it used to be what, 80 billion, oh sorry, 80 trillion, probably is touching 100 trillion now, if that. Um and with such an enormous debts, uh, deflation would be the natural path. But if governments allow deflation with rock bottom interest rates, then it's going to crush everything. Unemployment would be what, 50, 60%, maybe even worse. I don't know. Um, it will be absolute collapse, in terms of production, because industry will be just decimated. Um, housing prices will be like crashed by what, 80, 90%, maybe even more. There won't be any mortgage industry left, so you won't be able to get credit. Interest rates will be extremely high. So that's why governments won't allow it, and they will just print into eternity so they can paper over all this debt. So anyway, yeah, those were the some thoughts on Great Depression. I might do the same for some other crises and depressions as well. Thanks for listening. Please share your thoughts and comments, and I will see you in the next one. Bye.